Right, hi everyone. Glad to be back. All of you, press on, okay? So I'm the one guy that's standing between you and your lucky draw. All right, but let's get into it. As I promised right at the start of today, early this afternoon, I shared that I will be sharing how to build a successful trading plan, right? Coming out of a trading strategy. And towards the end, I think it'll be very benefiting for all of you. I have two trade management strategies that I employ for myself even to today. And these are strategies that help me to walk away with minimal losses. All right, so let's get right into it, right? Before I start, maybe you want to lean back and stretch a bit, right? We are into our last stretch of today. Can I have the next slide? Thanks. All right, so I will be covering what are the main pillars of a trading plan, the trader psychology, systematic process, and then, of course, trade management, right? All this, which I believe is very, very important, whether you are an intraday trader, more important if you're an intraday trader, right? Whether you're a swing trader, whether you're a long-term investor, right? Whatever it is, even if you're a value investor, it is also very important to be able to understand how to come up with a trading plan and how to manage your trades. Okay, so you have a question? Oh no, you're stretching. Okay, hi. Sorry. All right, let's go on. So, what are some of the main pillars of a trading plan? Next. So, over there you have this gentleman, Thomas Edison, and he's famously attributed the quote that good fortune is what happens when opportunity meets with planning. Okay, and I think it's Abraham Lincoln who said that, if I'm given a day to cut down a tree, I'll spend the first three-quarter of the day sharpening my axe. It's either him or it's the movie The Vampire Hunter, the Abraham Lincoln one. All right, but anyway, aside from what Thomas Edison has said, right, this over here, this triangle over here is what I believe constitutes the pillars of that's important to an investor, to a trader, right? You have the intellect. Okay, so very quickly, the intellect is the theories, the books you read, the financial knowledge that you have, right? How do you look at a balance sheet? How do you do technical analysis? All right, the emotions is something that's very, very important as well. I can guarantee you that if you were to take part in Moomoo's paper trading competition, right, you put on a paper trade, it's very, very different from putting your real money on the line, okay? And then, of course, there's a physical body where, you have to take care of your mental health. You have to take care of your own physical body so that you can operate at a peak condition when it comes to managing your trade, right? So we have colleagues here who used to be futures traders, right? They look at the intraday chart, and when they share with me that, when I keep looking at a chart, there's that sense of fatigue that comes on, right? Something that I can also identify with. All right, in my previous role, when I used to service hedge funds, portfolio managers, traders, it's always what I call a marathon sprint, right? So while everybody is trying to gun for a finish at the end of the year with very, very good numbers, they have to balance their portfolio at the end of every quarter, and it's always a sprint, right? Next slide, please. Yeah, so why do you need a trading plan, right? Because first and foremost, no plan means you're basically driving your trading results based on emotions, okay, or hearsay. You hear your friends say that, oh, this certain stock is good, you want to buy into it. You hear people on the stage share that, hey, there's a very low-risk option strategy, sure make money one, collect premium only, right? You want to do it. Okay, so it's very important that you understand yourself, right? You need to have a plan, right? The amount of time that you spend on the charts in the markets does not correlate, okay? Does not correlate to the profits you earn, okay? Just because I go to the swimming pool and I stay underwater for a very, very long period of time, that does not make me a fish, all right? After all that's said and done, there's more said than done, so which is why, again, you need to put your plan into action. So then, the next question that comes is, what goes into a trading plan, right? You need to have an idea of what you want to trade, right? Do you want to trade FX? You want to trade commodities? You want to trade stocks? Right? You want to trade cryptocurrencies? Right? It really depends on what you want to trade. And then by the extension, right, what are the derivatives that you want to trade from the asset classes? Right? Or what are the other products down the line that you want to trade from the asset classes. Why do you want to trade it? Right? Are you in it for capital gain? Are you in it for fame? Are you in it for cash generation? What are your parameters for entering the trade? Right? So, are you going to enter the trade, say, maybe at the London Open, at the New York Open, or even during the Asian Session Open? Right? So, it really depends. And finally, how will you manage the trade? Okay, so these are the few things of what goes into a trading plan. Next. So very quickly, I'll go into trader psychology, right? This is Dr. Van Thap. I'm not sure how many of you have read his books. Welcome to my trading room. Super Trader. Show of hands, anybody? Okay, yeah, there are a few. Right, so I've actually had the privilege of meeting Dr. Thap back when he came to Singapore for a CMT event. Sadly, however, he has already passed on about 3 to 4 years ago. Right? And his very famously quoted line says that you do not trade the markets. However, you trade your beliefs about the markets. So if you think about that quote, right, why do you buy a stock? Because you believe that the price will go higher. Why do you sell a stock? Because you believe that it's not doing well, you want to get rid of it, right? Next slide. So that brings me to my next point, right? As a trader, as an investor, there are many different kinds of cognitive biases that affects us. And I'll do my best to try to go through them. So confirmation bias is very simply, right, you go around looking for people that share the same view as you. Example, I think that, okay, Meta, not financial advice, I think that Meta is right now at a very nice support, is going to bounce, and then I'll go and look for people who support my view. And then those that do not support my view say, no, I think Meta is going to drop even more. No, you're wrong, Meta is going to bounce. If it drops even more, I'm buying the dip. Right? So that is confirmation bias. And that also ties into overconfidence bias, right? Sometimes you do so much analysis, right? You read so much into the topic, you think yourself somewhat of an expert, okay? And then that causes you to be stuck in a trade longer. Anchoring bias. So anchoring bias will be very simply, you are given a point of reference, and then that becomes that standard by which you measure everything. So if you go into the moomoo app, for example, right, we have a Morningstar rating, like what Alwyn shared earlier. And if the Morningstar rating tells you that, okay, this is a strong buy, 5 stars, with a 12-month target price of XX dollar amount, that becomes your anchor. Price is below that of the stock price, the stock current price is below that price target, you immediately have an anchor, right? And it's very, very dangerous to have an anchoring bias when it comes to the markets, because markets do not move in a straight line. In fact, it goes up, down, left, right, center, everywhere, before finally reaching its intrinsic value. So it's very dangerous to always be anchored to a strong bias. All right, then you have prospect theory loss aversion bias, which actually ties into the endowment effect. Cut the long story short, what it really means, prospect theory loss aversion bias, is that as investors, as traders, we tend to hold on to our losers for too long, our losing position for too long, and we tend to take profits too early. How many of you are guilty of that? Show of hands, right? Me included, okay? So this is something that impacts us a lot, right? When you see that you have your portfolio of listed stocks, suddenly the past 2 weeks, right, markets were selling off, and then you see, oh, I'm facing so much loss, I don't want to let go, right? Good for you because there's a rebound, right? But I'm just saying that, you know, at the end of the day, okay, if you had cut your losses, and when the market started rebounding, right, there was actually a triple bottom. If you go and check the S&P, right, and then you buy on that breakout, your returns will actually have been better than if you just held on to it, okay? And then, of course, there's herd mentality. I don't need to speak too much about that. I think as Singaporeans, herd mentality is something that runs in our blood, is in our DNA. I go to Ghim Moh Market where I don't stay there. I go to Ghim Moh Market, I see the line, the queue is long, I'm going there. Food must be good, right? Okay, and this happens anywhere else in the rest of the world, right? I see a queue is long, I'm just attracted to it like that house fly to the blue light, right? So I don't even know what I'm queuing up for anyway. All right, and then finally, sunk cost fallacy. So sunk cost fallacy, again, you spend money buying something, it's in losses, right? And you tell yourself, hey, I've held on to this stock for many years already. Why not just hold on to it longer, right? Another 6 more months, another 1 more year doesn't really make a difference. All right, so these are the kind of cognitive biases that actually impacts a lot of us. It's not just in trading, not just in the markets, but actually on a day-to-day basis as well. And as investors, as traders, we have to be very, very mindful of it. Next slide. So, having understand that it's important to have a trading plan, right? It is important to be aware of all these cognitive biases, right? We need to then build a systematic process. And I break it down, right? I break it down in the short time that I have. I break it down quite easily for you guys. We have all the data, right? What we want is to move from the data side across to the right side, okay? So we have data, right? The moment we have data, we get information. But just because we have information, it doesn't mean we know what to do with it. From information, we need to go to knowledge, right? We need to understand what does this information tell us. And eventually, we're supposed to move on to application. No point having the knowledge of what this information tells us, but we don't know how to apply it to our trading. Okay, if I were to tell you that price of stock A is on support, right, and it's currently undervalued, those are information that we know. But what do you do about it? Then how do you apply it? Next slide. Okay, so then I'll walk you through the life cycle of a trade, and we break it down into before the trade, during the trade, and after the trade. Now, just a show of hands, how many of you think that before the trade is the most important part of the process? Okay, a few. What about during the trade? Show of hands, how many of you think that during the trade is the most important part of the process? Okay, only a couple. After the trade? Okay, more hands. Right, not entirely a trick question, okay, but I will have to say that during the trade is one of the most important part of the process. After the trade is the second most important. Before the trade, not the most important. And I will explain to you why, okay? Before the trade, right, some of the questions, some of the thought process that you need to think through, like what I shared earlier this afternoon, top-down approach, right? You want to start off with what is the thematic play here, right? What is the kind of narrative that you want to play into? Are you playing into the earnings season? Are you playing into a sector rotation, more defensive, more risk on, more risk off? Are you playing into global macro environment? Oh, US Federal Reserve is going to cut rates. What does that mean for risk on assets, risk off asset? What does it mean for FX? What does it mean for treasury, right? That kind of thing. Or are you playing into sentiment, right? So you're looking more at the volatility, fear, or greed of the market. And then from that, have you done your top-down analysis, right? Which I already walked you guys through. And what does the intermarket correlation tell you? You know, in this day and age when the markets are more and more synchronized with one another through technology, how many of you were impacted just 2 days? It's 2 days ago by the CME shutdown. CME data failure. No? None? Futures trader here, anybody? Okay, yeah, we got a few. Were you impacted by the CME shutdown? Okay, no. Maybe you're trading a different kind of futures, right? But anyway, right, what happened was that a lot of index option traders, a lot of our friends up north in Malaysia, those that are trading palm oil futures, they were very, very much impacted by CME data being shut down, right? So that was really, really bad. And if you do not know how intermarkets play with one another, then you'll be stuck. You'll be sitting there, oh crap. Now I have a position that's exposed. I cannot access it. I do not have the live data. It doesn't tell me the pre-market move, what is happening, right? So because of that, right, you may miss out a move. What I did when the CME markets were down, which led to S&P and Nasdaq futures being down, okay, what I actually looked at was I went to look at oil futures, right, because they are correlated to a certain extent. I went to look at treasury. I went to look at the US dollar index, right, to get an inkling of where the markets will open should the data be back online again. Right? So intermarket correlation is very important. And then finally, is your trade that you're going to enter into, that you're planning, a high conviction one? If it's a high conviction one, it ticks all your boxes. Okay, what are you going to do about it? How are you going to approach it? If it's not, are you still going to enter the trade, or are you going to walk away? I think as retail investors, I like to say that we always have the advantage of walking away. Right? We're not like those institutional investors that they are paid to be in the markets. Next slide. So creating a systematic process, right? One way of finding thematic, okay? If you guys do not know how to access, you don't really know what's the theme that's going on right now. On our moomoo app, okay, again, you go to markets, and then that's the number one arrow. The second arrow, you can go to the individual markets, United States, Singapore, so on and so forth. Next slide. And when you click onto it, right, you can actually see the word there. Even on your phone, you can scroll. I'm sorry, the words are a bit small. But you can actually scroll to this thing called investment themes, right? And over here, I will just read out to you some of the themes, right? Will be social media, ARK ETF, energy storage deposit, right? Rare earths is right at the top over there, right? Sports betting, so you're starting to see all of this sports betting thing coming up. So investment themes, right? This actually helps you to formulate your top line approach. Next slide, please. Another way of actually coming up with sentiment analysis is our moomoo AI, right? Over here, I actually did a very quick ask on moomoo AI, right? Simply, I just asked, hey, what is the most talked about topic on social media, right? And then moomoo AI actually runs out the whole thing for me. And from there, I can actually go and pick out, okay, what is social media talking about? Is there any value if I were to trade on these ideas, right? I can even go one step further, and I can just ask something very simple. What has been the recent sentiment in the market? Are we more risk on, or are we more risk off? And then moomoo AI will come up with all these answers for us. All right, so I believe this feature is also free for our new users, right? I believe you have 10 queries, or maybe they have raised the level, but you have about there, which is already helpful enough. So you can use actually all these tools on hand to help you figure out what is the top line thematic that you want to play into. Next slide, please. So now that you already identify before the trade, right, how you want to play into it, whether this trade is a high conviction one, right, let's talk about during the trade, all right? This is where I think we have to pay a bit more attention. Okay, during the trade, it requires a bit more active management approach. Okay, I think whether you're a long-term investor, short-term trader, active investment is always very, very important in all your positions, which is why you have your long-only funds doing their yearly portfolio rebalancing. Okay, so it's very important. So has your technical levels and key price levels been identified? Right, on the chart, have you looked out for all your long-term support resistance levels? Is current market price near these levels? If they are, how do you think the markets will react? Have you identified your preferred case and alternative case? Now, I think this part is important. I cannot overstate how important it is. Even if you look at my Tuesday webinar, right, when I do a live analysis for my friends online, you'll see that I will always give a preferred scenario and then an alternative scenario. Now, I have people coming up to me and telling me, hey, Isaac, you're just not accurate enough. You don't dare to give a directional call. You don't dare to give a directional bias. If the stock is good, just tell us to buy. If it's not good, just tell us to short. But, it's not as simple as that, right? We don't always get it correct. My own back-tested results, I only have a 76% accuracy, right? So I'm not 100%. I'm not God, right? But what is important is when you have a preferred scenario, you can position your trade in line with it. And the moment that preferred scenario is not playing out, bam, you immediately have a plan B. You don't have to second guess the markets. You don't need to worry about what you're going to do, whether you're going to hold on to a trade or let go, right? You immediately turn around, alternative scenario, right? So that is why having a preferred scenario and an alternative scenario is very important. Give you a good example, even if you're a value investor. Stock markets are going up, all right, and then suddenly we have a 20% sell-off. What are you going to do? Are you going to dollar cost average? Are you going to lump sum invest? You need to be able to answer that question. You're a value investor, so clearly you already believe in your stock, you're not going to get out of it. But what are you going to do with the sell-off? Are you going to dollar cost average or lump sum invest, right? That's always something to think about. Okay, are there plans to scale into the trade? This is more for swing trading, right? Something that I really like. I'll share with you guys later. I call it the compounding the trade and taking partial profits. Are there plans to deleverage and pay yourself, right? So sometimes, you trade the markets, you're sitting on a nice profit, right? Learn to pay yourself. You don't go to your boss and say, hey, I'm going to work for you for the next 1 year. Don't worry, just pay me at the end of December. Happy to take my pay like that, right? Nobody does that. And of course, do you have an active stop strategy in place, right? Do you have a level that the moment price closes outside of this level, you're out regardless? All right, so this is during the trade, right? You can start to see is a bit more active management over here. Next slide, please. Right, and in line with what Kathleen shared earlier about risk-reward, this is a picture that I really want to share with you guys. Right, over here, I title it "Win Rate is not as important as risk-reward ratio." So the top row is your win rate, right? So every column, 10%, 20% win rate, 30% win rate, 40% win rate, all the way up to 90% win rate. Okay, and then every row is your risk-reward ratio, right? 1:2, 1:3, all the way down to 1:9. Right? Clearly you can see there's a bit more green than red, right? But what I'm trying to tell you is, even if you have a 20%, so on the left hand, the column, even if you have a 20% win rate, right, but you come in with about a 1:5 risk-reward ratio, like what I shared during a panel session earlier, you will already consistently become a profitable investor or trader. All right? So of course, it gets even better if you have a win rate of, say, maybe about 40%, right? Then all you need is a 1:2 risk-reward ratio. Long term, okay, based on laws of statistics, you will generally be profitable. Next slide, please. All right, so from there on, we move into after the trade, right, which is really post-trade review. There really isn't much to do after the trade, because whether you already take your profits, whether you already take your loss, that's that. It's done. It's time to clear your mind, move on to the next one. But before you move on to the next trade, okay, I think you need to ask yourself two very important questions. So imagine with me, if you will, a sort of a flow chart, right? Did your position hit take profit? Yes or no? Did your position hit stop loss? Yes or no? So let's do the take profit side first. So if your position hit take profit, what are the emotions that you are feeling or having before closing the position? Are you very excited? Or do you not want to close the position? More often than not, I don't want to close the position because I'm seeing a 27% gain. Why do I want to close the position? No, for the youngsters, I want to take a screenshot. I'm going to show this to every single one of my friends on social media. Hey, I'm up 27% on this position. Where are you? I don't even see you. All right? What worked well going into the trade? Right? Was it the technical setup? Was it a fundamental setup? Right? Or maybe you were just, hey, well, all the stars align. The moment I look at this chart, it just jumped out to me, I am profitable. And then you want to take it. Right? So these are the times that you actually write it down. You start reviewing. Right? And it actually helps you prepare and build on your trading strategy for the next subsequent trade. Next slide, please. Now, if your position hits the stop loss, right, there are more questions to ask. Same thing, you start with what are the emotions that you have before closing this position. Is it one of regret? Or sometimes, increasingly, based on my own personal journey, I found out that I was moving from, how come I'm losing this trade? To actually, on hindsight, this should not have been a trade that I should have taken in the first place. It did not meet my criteria at all. Why did I even enter into this trade? Right? Because I find out that I tend to be a bit more aggressive. I like to chase the trade. Okay, so did I close the trade prematurely? If yes, why? Are you afraid of loss? Loss aversion bias? But on the flip side, okay, if you didn't close the trade prematurely, then why not? Right? So what did not work going into this trade? I think it's very important to always sit down and ask and review, right, why this trade doesn't work out. Next slide, please. All right, so now that we have the before, during, and after, right, I would sum it up as before the trade, right, you really have your own technical factors. You decide top line, what's the thematic reasoning for entering, right? You do a top-down analysis, your TA, your FA, then you enter the trade, right? It fulfills everything, you enter the trade. During the trade, it's all about active trade management, your positioning, right? And then after the trade, it's very introspective. You review how you feel, okay, and how come the trade worked out, how come it didn't. And finally, right, we wrap it up with trade management, right? I will share with you guys 2 strategies. Next slide. Thank you. 2 strategies on how you can actually come out of a trade with as little losses as possible. And if you're really, really experienced, then you really want to ride and drive into your winner. So let's start off with the break-even trade. Okay, this is a chart of Tesla, right? You can see that sometime this year in April, okay, Tesla was going into a triangle base formation right at the bottom, right? And then you can see, I put it over there, shortly after April, after the Liberation Day sell-off, strong, sharp rebound, where Tesla actually did a bullish triangle breakout. So that is where you have your first entry, right? I identified the entry as a breakout, triangle breakout on a pullback. Okay, so you enter on a pullback, that's your first entry. Stop loss, keep it very simple, just below the previous low, right? So you have it over there. The long-term target that I've identified is actually based on the monthly chart and on the weekly chart. I've put the factors over there. It's a monthly swing high in close, and then it's also the weekly double top neckline. So this trade works out to be a 1:2.76 risk reward. So nearly 1:3, something that I'm very comfortable with. So I enter this trade upon the breakout, right? Next slide. And look what happens, okay? So the next slide, price has rallied. Did you see where my stop loss is now? Can you go back to the previous one? Thank you. And then back to the current one. Thank you. And then back to the previous one. And back to the current one. Thanks, Chloe. So you can see that my stop loss was actually immediately, the moment the trade rallied, my stop loss from a predefined stop position immediately became a trailing stop. But it wasn't a blind trailing stop. The trailing stop was actually moved to just above my initial entry. And there's a reason for this, friends. The reason for this is because when I move my trailing stop to above my entry point, even if price were to come back down and take me out, I would have gotten away with a small profit. And that is enough for me to cover commissions, swaps, and any other fees that I need. So this is a true break-even trade. 0 win, 0 loss. All right? Next slide. So you can see it went up, right? It went up. I didn't take any profit at all, okay? But price immediately shot back down, took me out, right? So this is what I call a break-even trade, all right? And for newbies, right, being able to master this break-even trade, I cannot emphasize how important this is in building your confidence as an investor and as a trader. You will go from, wow, this break-even trade is really good, 0 losses. And as you mature in your trading and investment journey, it becomes, how do I move on from break-even to becoming profitable? Right? But the fact that you are break-even consistently means that you already last long enough in the game to be able to figure out your next steps. Let's move on. So very quickly, we move on to the next one, which I call it the take partial profits compound trade. Too long, the name. Maybe I should copyright this thing. Right? Same setup, same chart, Tesla. All right? So using the same exact setup. Okay? Triangle-based consolidation with a bullish breakout. Did the first entry on the pullback, triangle pullback. My predefined stop loss, risk reward is the same, 2.76. Next slide, please. You look at the purple arrow. Okay, price has rallied, right? So same thing, price has rallied. In the break-even trade scenario, I move my trailing stop up to above my break-even, to above my original entry, right? So no loss whatsoever. But over here, I take on a bit more risk. My stop loss did not move, right? Price has already gone 50% towards my final target, my long-term target. But what's the difference over here? I paid myself. I close out 50% of my position. Do you see that small half arrow? I close out 50% of my position. So even if I were to be stopped out, price comes all the way down to my original stop loss, I don't have to worry because the profits that I took out, that I paid myself, would have covered up for the loss. Okay? So, next slide, please. So price came down. My first position is still in. Though it's already at 50%, my first position is still in. I continue with my analysis, right? There was a midterm ascending trendline support, right? I entered on the third touch. Okay, you can see entry number 2. My stop loss for trade number 2 now becomes at the entry of my first trade. All right? Next slide, please. And then you see that price continues to consolidate. Right? Price continues to consolidate. Can you go back to the previous slide, Chloe? Okay? And then go back to the current slide. You can see that my trade number 1, my stop loss has now become the active trailing stop. So it's a bit of a hybrid of my break-even trade, right? I already am 50% profitable on my first trade, and now it's completely protected. So even if I'm completely stopped out, I will have slight losses for my trade number 2, and 50% of my profits secured on trade number 1. So trade number 2, you can see that, yes, price consolidated sideways, but it never ever stopped me out, right? Okay, and then next slide. Okay, price finally rallied all the way up to my long-term take profit. Okay, and I walk away from this trade having my first initial 50% profit, and then the remaining 50% continue to ride the trend, and then my second trade compounding on my first trade, right, without moving the second stop loss. Okay, so this is how I actually take partial profits along the way while compounding my position. All right, but disclaimer, this is not something that should be used for novices, right? It is very, very tiring because this entire trade played out from when? From April, okay, all the way until the start of September, right? So you need to be able to have the mental fortitude, right, to ride on this position trade, on this swing trade all the way. And especially when it consolidates for the second trade, that part will really, really test your belief in your trading system. All right, so putting all this together, it really tells you why is it so important to have a trading system. Because when you have a trading system, you immediately know how to react to the markets. All right, and then after the trade, you start reviewing, you get to understand yourself better. Right, like what I told one of our friends just now, trading is not about you comparing to other people. It's about you being a better version of yourself, of your previous self. It's always you against you. All right, next slide. So I think that's the last one, I think. Yeah, so with that, thanks everyone. That is how you can actually build a successful trading plan. And these are the 2 trade management strategies that I use it for myself. Very happy to share with all of you. Thanks everyone. And now for your favorite part of the session, lucky draw.